Welcome to the Monday Futures Market Outlook for September 19th, 2011. This is Patrick Ceresna. For those of you that have not had the opportunity to try out the eMiniSource.com trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles that we've gone through. The market crossed bearishly below that 80-week moving average and continues to consolidate at or below that level, which begs the question as to whether we are in a prolonged bear market like this signal has given in the past. At this stage, with the deterioration of the Eurozone and so on, we have to, at this stage, respect the downtrend that is in place, and we'll talk about that on the daily charts in just a moment. Just to make some key intermarket observations, the last 2 months have obviously dynamically changed the landscape of the market with that dramatic drop in the marketplace. It certainly has shown the vulnerability of a majority of investors, and certainly is changing the mindset that a lot of investors have toward those investments, which could obviously continue to damper on the buy side of the market. The US dollar has also at the same time broken out of its range on the upside. And we see that trend continuing to this morning as the US dollar has now broken significantly higher. This trend naturally dampens the commodity markets. We're seeing weakness in copper, oil, and should make it very difficult for commodities like gold and silver to really break out with any real momentum. And also the 30-year Treasury bond continues to rally higher as we see a flattening of the yield curve. There's a lot of talk about Operation Twist, in which they're going to attempt to manipulate the yield curve as it is structured. But at this stage, it is very clear that the bond market is pricing in some significant weakness on the economic front. When we take a closer look at that S&P 500 on the daily charts, we see that was obviously that big market crash in that first week of August, and subsequently the market's been flagging ever since, and we had a rally attempt back up in the zones, but we were saying that there's some pretty significant overhead resistance levels up here in this 1210, 1220 area, as well as up in the 1250, 1260 area. Even though we saw a very strong rally last week, it would be very natural off these overhead resistance levels for this market to continue to break down. We think that it's a very good probability that this market stays relatively range bound even for the remainder of the year, with a full retest of that 1080 to 1100 area on the downside. And if there's a good enough catalyst, we could see even a market drop down to the 1000 level where it was the flash crash lows. Now again, I'm not really at this stage looking to forecast the 1000 level, but to anticipate a retest of the lows at some stage going into October, I think is a very realistic expectation. Next year, when we take a look at that US dollar index, you can see how that there was this big euro gap down as well. A number of other currencies had some significant moves. It forced over the weekend this US dollar index to create a nice big gap higher, trading right back to its previous highs near 78 level. Really at this stage, we were looking for that little consolidation back to hold at that 75 to 76.50 area, and really at this stage with us now attempting to break out to new highs. If we do, then this consolidation that we saw is going to be the springboard to launch a move to 79.80 on the upside of that dollar index future. If that happens, that should weaken oil and copper and a number of other commodities, and as well it should weigh on the stock market as well. When we look at copper futures, we were identifying that same flagging wedge formation higher, suggesting that copper could easily retest obviously as high as 420, but eventually copper would roll over and complete a measured move lower. Now, we were directly trading into the 380, 390 focal point below, and really at this stage with the dollar just breaking and everything rolling over, it's quite possible that within just days or by the end of this week, we could see copper even trading as low as the 350 to 370 area on the downside. In the bigger picture, we could see even significantly weaker copper prices down in towards the $2.80 to $3 area, but I don't think that that's going to probably even happen this year. That kind of a weakening of copper may be a story into the early part of 2012. Nonetheless, so long as we have a strong U.S. dollar, copper will naturally be weighed down on its price levels. Next year, I want to take a look at gold futures, and gold has now created a double top along the 1900 level that really is not confirmed yet. There is room for gold to still make one more push higher in this topping formation, which could see a very quick retest of or push even up to 1950 or 2000 if given a good enough reason in Europe, like a full Greece default or something like that. But overall, I believe that gold will probably remain range bound between the 1700 to 1900 area predominantly for the remainder of the year, with probably even a bigger risk of it being below 1700 than above 1900. So overall, I would remain relatively neutral on gold rather than distinctly bullish, and look for the gold to further consolidate within these price levels. Next year, I want to take a look at crude oil, and when we do that, we were talking about that same wedge formation like we saw in copper and the stock market and everywhere else. Essentially, at this point, if we do get a rollover of crude oil, there's a measured move that goes as low as $65, $70, but at least at minimum, we think that crude oil should go for a solid retest of the 78, 80 area down below. There's always a chance that it double bottoms down in that zone, but if the U.S. dollar begins any legitimate rally, this could accelerate oil down much quicker, and the low may not come in until the $70 area down below. At this stage, the only scenario from which we would become more neutral on oil would be as if oil was able to significantly exceed the 90-92 focal point on the upside. At that stage, we'd have to adapt a far more neutral and range-bound perspective on oil. But at this stage, the pattern that we see here is distinctly bearish oil. Finally, I want to take a look at that 30-year Treasury bond, and Treasury bonds continue to edge their way higher towards the top end of the range in the 40-42 zone. It's quite possible that the 30-year Treasury bond attempts to break out as the yield curve continues to flatten. While we really are not, we find it hard to believe that yields on the long end of the yield curve could get any lower when one of these trends are in place, and when economic circumstances are uncertain. Treasury bonds can do all sorts of things and go to test levels that seem not rational. Really, at this stage, if we have any technical breakout, we would be looking for a break even as high as 145 to 150 on the upside of these Treasury bonds. In the much bigger picture, that probably would be a place where we would see major highs develop on those Treasury bonds. But at least in the short term, I find it hard to justify trying to short these Treasury bonds. That was your Monday Futures Market Outlook. Thank you for joining me.